approach ensures that forex reserves act as shock absorbers, safeguarding the economy from external spillovers, while supporting competitive and orderly market conditions. The flexible or market-determined exchange rate regime is not merely a tool for managing external shocks. It is an important element of our approach to macroeconomic and financial stability. By combining market discipline with prudent intervention, we have created a system that supports stability, resilience, and growth. Let me now focus on financial stability. The financial parameters of banks and NBFCs continue to be strong. The incoming data suggest that the gap between growth of credit and deposits of scheduled commercial banks has narrowed, with deposits keeping pace with loan growth. In fact, on the financial sector, I can say with confidence that I think the health of the financial sector today is perhaps at one of its best in a long time. The Reserve Bank's supervision of the financial sector and its entities continues to be vigilant and proactive. Incipient signs of stress, if any, either at the systemic or entity levels, are monitored closely and proactive action is initiated. The effort is always to resolve the issues non-disruptively. Continuous engagement is held over several months, sometimes even exceeding 1 year, with the regulated entities. Only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. In fact, there are a large number of entities where the corrective action is taken and where we simply do not take any action because the response by the regulated entities is found to be, very proactive and, very responsive. And so in many cases, without imposing any restrictions on their business or other kinds of activities, the problem gets resolved. Obviously, the list is not known outside. That list is much longer. And the total number of entities, I'm not being defensive about it or in any way. Why I'm emphasizing on this is that this is something which we have to do in the interest of stability of the system as well as the stability and health of the individual entities. So only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. To address the issues of unclaimed deposits, inoperative accounts, and frozen accounts due to pendency of KYC updation, banks have been advised very recently once again to take necessary steps urgently to bring down the number of such accounts and make the process hassle-free. Further, banks have been advised to segregate the accounts of beneficiaries of various central and state government schemes through direct benefit transfer, that is DBT, and facilitate uninterrupted credit of the DBT amounts into their accounts and also utilization of the DBT amounts by the account holders. And we have advised the banks to do it without inconveniencing such vulnerable segments of customers, because the DBT beneficiaries are usually, and they are the vulnerable sections of the society. So being fully mindful of that, we have emphasized that there should be a kind of a seamless and smooth flow of DBT amounts into the bank accounts of such individuals in a situation so that it facilitates the individuals to withdraw the money to meet their various requirements. Progress made by individual banks in this regard will be monitored by the Reserve Bank. I would now like to turn to the external sector. The statement today is a bit, because we have too many announcements, so I request your continued patience. External sector. India's merchandise exports expanded at a 28-month high pace in October. Merchandise imports also increased for the 7th consecutive month. Services exports sustained buoyancy and posted double-digit growth in second quarter as well as in October 2024. The robust services exports, together with strong remittance receipts, are expected to keep the current account deficit within sustainable levels during 24-25. On the external financing side, gross FDI to India increased at a robust pace. I'm talking about gross. The gross FDI to India increased at a robust pace during the first half of the year. Net FDI, however, moderated during this period due to higher repatriations and rising outward FDI. Foreign portfolio investment, that is FPI inflows to EMEs have generally declined in October. Net FPI inflows to India stands at US dollar 9.3 billion so far in the current year, that is from April to December 4th. And this was supported mainly by inflows in the debt segment. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the last year. India's external sector remains resilient, as reflected in various key indicators where India has been consistently performing well. And the key indicators and the data they are given in the footnotes. In order to attract more capital flows, in order to attract more capital inflows, it has been decided to increase the interest rate ceilings on FCNRB deposits. Accordingly, effective from today, banks are permitted to raise FCNRB deposits of 1 year to less than 3 years maturity at rates not exceeding the ceiling of overnight alternate reference rate, that is overnight ARR, plus 400 basis points as against 200 basis points at present. So in addition to the overnight ARR, currently the banks are allowed a spread of 250 basis points, that is being increased to 400 basis points. Similarly, for deposits of 3 to 5 years maturity, the ceiling has been increased to overnight ARR plus 500 basis points as against 300 basis points at present. This relaxation will be available till 31st March 2025. I shall now announce certain additional measures. I again request your patience because the additional measures, they are very important. The first one relates to the FX retail platform, and this is how it is. The FX retail platform, which was launched in 2019, is now proposed to be linked with the Bharat Connect platform of the NPCI. This would enable users to transact on the FX retail platform through mobile apps of banks and non-bank payment system providers. This will expand the reach of FX retail platform, enhance user experience, and promote fairness and transparency in pricing with adequate safeguards. The second announcement relates to introduction of secured overnight rupee rate, SORR, a benchmark based on secured money markets. With a view to further develop the interest rate derivative market in India and improve the credibility of interest rate benchmarks, the Reserve Bank proposes to introduce a new benchmark, namely secured overnight rupee rate, that is SORR, which is based on all secured money market transactions, that is overnight market repo as well as TREPS. The third announcement relates to Connect to Regulate, an initiative for open regulation. As part of Reserve Bank's consultative approach in framing regulations, a new program, namely Connect to Regulate, will be launched under the ongoing RBI at 90 commemorative events. A dedicated section in the Reserve Bank's website will be made available for stakeholders to share their ideas and inputs on specific topics. So we will give out a specific topic on that we are not going to upload a discussion paper or anything, but we will just mention the topic, and we would like all stakeholders to give their opinion, suggestion and thoughts to the RBI. So it is that makes our process of consultation much wider and much more flexible, which has been our approach over the last few years. Next announcement is introduction of podcast facility as an additional medium of communication. Over the years, the Reserve Bank has expanded its communication toolkit and techniques to enhance transparency and better connect with the people. In continuance of this endeavor, the Reserve Bank proposes to add podcasts to its communication toolkit for wider dissemination of information. And the next announcement which I am going to read out is very important for the agricultural sector, especially for small farmers. And that relates to collateral-free agricultural loan enhancement of limit. The limit for collateral agricultural loans was last revised in 2019. Taking into account the rise in agricultural input costs and overall inflation, it has been decided to increase the limit for collateral-free agriculture loans from rupees 1.6 lakh crore per borrower to rupees 2 lakh per borrower. This will further enhance credit availability for small and marginal farmers. The next announcement relates to UPI. A credit line on UPI was launched in September 2023 and was made available through scheduled commercial banks. It has now been decided to permit small finance banks also to extend pre-sanctioned credit lines through the UPI. This will further deepen financial inclusion and enhance formal credit, particularly for the new-to-credit customers. Next announcement relates to artificial intelligence, its deployment in a very prudent manner. The financial sector landscape is witnessing rapid transformation enabled by technologies such as AI, tokenization, cloud computing, etc. In order to harness the benefits from these technologies while addressing the associated risks such as algorithmic bias, explainability, data privacy, etc., a committee comprising of experts from diverse fields will be set up to recommend a framework for responsible and ethical enablement of AI. I repeat, a framework for responsible and ethical enablement of AI, and the acronym is FREE AI in the financial sector. The last announcement relates to dealing with mule accounts. As part of the Reserve Bank's continued efforts to prevent and mitigate digital frauds, an innovative AI/ML-based model, namely the MuleHunter.ai, has been developed by the Reserve Bank Innovation Hub at Bengaluru. This will help the banks to deal with the issue of mule accounts expeditiously and reduce digital frauds. Let me now conclude. The world today is characterized by intricate complexities and profound uncertainties. As a central bank, our job is that of an anchor of stability and confidence, which would ensure that the economy achieves sustained high growth. Since the last policy, that is since the October policy, inflation has been on the upside while there has been a moderation in growth. Accordingly, the MPC has adopted a prudent and cautious approach in this meeting to wait for better visibility on the growth and inflation outlook. At such a critical juncture, prudence, practicality, and timing, I repeat, at such a critical juncture, prudence, practicality, and timing of decisions become even more critical. Our endeavor in the Reserve Bank has always been to implement timely and carefully calibrated measures to derive the maximum impact. This will continue to be the guiding principle for all future actions also. As Mahatma Gandhi had said, and I quote, "There is nothing that cannot be attained by patience and equanimity." In the last few years, we have traversed one of the most difficult periods in the history of the Indian economy and perhaps in the global economy. And this has been a very difficult period in the economic history, in the history of Indian economy and the global economy, just as I pointed out. It was a period of relentless turbulence and jolts. As a country, we can derive satisfaction that the Indian economy has not just navigated this period of trials successfully, but has emerged stronger. As we strive together towards making India a developed economy, I recall what I had said in my statement of February 8, 2023, wherein I had quoted Netaji Subhash Chandra Bose, "Never lose your faith in the destiny of India." Thank you. Namaskar. Every 2 months, I have been presenting the monetary policy statement on behalf of the